Welcome back to Sunny Stocks India. Today we are going to analyze and try to value Unicommerce eSolutions Limited. Before we value this company, one very important thing we need to understand. Unicommerce today is effectively two very different businesses operating under one roof. The original Unicommerce business provides e-commerce operating software through its Uniware platform. It helps businesses manage orders, warehouses, sellers, payments, and returns reconciliation, essentially sitting between the sellers, marketplaces, warehouses, and logistics providers. That's what Unicommerce was doing since its inception in 2012 until March 2025 when Unicommerce completed the acquisition of Shipway Technology. Shipway added shipping aggregation and automation capabilities along with Convertway, its marketing automation offering. But here, the important part is these two businesses have completely different economics. Management has indicated that Uniware operates at roughly 80% gross margin while Shipway operates at only around 20% gross margins. So, a 1 crore of additional Uniware revenue is far more valuable than 1 crore of Shipway's incremental revenue. And this distinction becomes extremely important when we value the company. So before getting into valuation, let's understand the market opportunity. Unicommerce operates in India's rapidly expanding e-commerce enablement ecosystem like inventory and order management, reconciliation, logistics automation and courier aggregation. India's addressable market was estimated at approximately US 1.15 billion in 2023, while the broader transaction processing opportunity, including adjacent products and international markets, was projected to reach approximately US 3.9 billion by 2027. More importantly, this market still appears significantly underpenetrated. A large number of Indian brands and sellers continue to manage parts of their e-commerce operations through spreadsheet, disconnected softwares, and fragmented systems. So the opportunity is substantial. The question is whether Unicommerce can successfully capture it. The company's existing footprint is already significant with more than 8,000 live clients, an annual Uniware transaction run rate of 115 crore transactions, and more than 12,250 facilities. It has disclosed customers' ecosystem includes names such as Lenskart, Mamaearth, Boat, Fab India, Sugar, Imami, and many others. So this is clearly not an experimental platform. It is already operating at a meaningful scale. Now let's come to the valuation part. The stock is currently trading at around 85, below its 108 IPO price. The company IPO'd in August 2024, so the company today is approximately 23% below the offered price, giving the company a market capitalization of roughly 950 crores. As stated earlier, I would analyze Unicommerce as two separate businesses. Uniware, a high gross margin SaaS and software business, Shipway and Convertway, a much lower margin logistic tech and shipping business. Coming to the historical performance, let's look at consolidated performance. Revenue increased from approximately 59 crore in FY22 to 204 crore in FY26. During the same period, EBITDA increased from 7 crores to 44 crores, margins expanded from 12% to 21.5%, PAT increased from 6 crores to 20.5 crores, and most importantly, operating cash flows reached 47 crores in FY26. At first glance, these numbers look excellent, but the acquisition of Shipway dramatically changes the revenue mix. Uniware contributes approximately 61% of revenue, but it could be contributing roughly 86% of gross profit, while Shipway represents almost 40% of revenue, but only around 40% of estimated gross profit. This, in my opinion, is the single most important number to understand about Unicommerce business today. And this explains why consolidated gross margin fell from 69.4% to 53.3%. A casual investor could look at that and conclude Unicommerce business quality is deteriorating. But no, the decline largely reflects the consolidation of Shipway, a structurally lower gross margin business. The underlying Uniware business remains extremely. In fact, Uniware's profitability has improved substantially. To me, that's an excellent quality SaaS business. The issue isn't profitability. The issue is growth. Can Uniware achieve 15% plus organic growth while Shipway reaches 20% growth and break even without permanently consuming the profits generated by Uniware? If the answer is yes, the earning trajectory can change substantially. That would take my estimate of rolling 12 months EPS from roughly 2.1 to around 2.68 as we move through these quarters. And if the market is willing to value the business at 50 times earning, my scenario produces an indicative value moving from 85 to roughly 134 per share. Please note, the market will only continue paying such a price to earning multiple if the growth and execution justify it. My view on Unicommerce is positive, particularly because the underlying Uniware business has extremely attractive economics. If Shipway continues growing without consuming Uniware's profit, the actual shareholder value creation will happen. And finally, remember that new age technology businesses often trade at high PE multiples. That means they can rise rapidly when the execution exceeds expectation, but they can also correct sharply when growth disappoints. So continue tracking the quarterly numbers, understand the risks, and please do your own research before making any investment decision. This was my analysis of Unicommerce eSolutions Limited. Thank you for watching. Bye bye.